I think what we are witnessing is the end of fiat currencies as we know it. It allows any company across the spectrum, a service country, a manufacturer, to just implement this technology, and it immediately streamlines their business. It's going to be more transformative than the Industrial Revolution, or it's going to be on a level that when people look back at it, they're going to go, this was the time that this shift happened, and this is why it did.
Gary Wagner returns to the show. He is the editor of thegoldforecast.com. We'll be talking today about not only his gold price outlook updates, but also his updated views on the economy and what the Fed may do next. It's been 2 months since I've had you on, Gary. Welcome back.
Thanks so much for having me. It's great to be here.
Since April, the inflation numbers have come in twice since we spoke, and it looks like the data has been trending downward, although, as you know, still nowhere near the Fed's 2% target. The last readings came in lower than expected. But not only that, Gary, earlier in the month, the U.S. added more jobs than expected as well. So we're kind of getting conflicting indicators. On the one hand, it looks like the labor market is still strong, but on the other hand, the inflation data looks to be cooling. So let's just take a look at this data first, and we'll talk about the Fed. How are you reading inflation right now?
Well, inflation is absolutely slowly ticking down, considering it was 9% in 2022 and recently got just around 3%. That's huge, but the Fed is steadfast in saying we need it at 2%. So if we come in with readings at 2.7, they throw that data out. That's not good enough. I think that they've done a good job, but I'm fearful that they are a little too hesitant to pull the trigger because the Fed has a dual mandate, right? One of it is inflation. The other one is maximum employment. And by lowering inflation, it has the ultimate effect of reducing the economy and taking jobs or lessening the jobs that are in the marketplace. And so they're not focusing on that, and jobs continue to be strong. So it's like one step forward, one step back. They're not gaining the kind of ground that they could be.
Do you think it's possible that the Fed will look at the unemployment data, which has been trending up, by the way, it's now at 4%. If that number continues to go up, do you think the Fed will say, look, the unemployment rate is trending up. Inflation, although it may still remain sticky above 2.5%, we're going to cut rates because we're worried about the labor market, like you mentioned, the second mandate?
I personally think if they don't do that, they might be shooting themselves in the foot. They were tasked with a huge, huge project to get inflation down at one of the highest levels due to an unforeseen black swan event. And they did it. And the fact that they're sticking at this 2% number, because that's been their target as long as I can remember, doesn't make as much sense as calibrating it to fit the economic scenario that's in play now. And it's different. As we've just pointed out, you have a strong economy and you have inflation that is still elevated, but coming down. So what do you do about that?
I like to point something out, Gary. The last time the Fed cut rates was back in 2019. It was at 2.5%. It came back down to zero when the pandemic hit. Now, what happened to the inflation rate? Well, as you know, during the pandemic, inflation was deflationary. But even before then, the Fed was on the verge of lowering rates. The inflation rate was only at 2.5%, 2.3, but still higher than, I guess, the 2% target. I'm talking about headline inflation. Perhaps core was closer to the 2% target. All I'm saying is that the Fed has had a history of not waiting for it to go down to exactly 2% before cutting rates.
That's correct. The Fed has had a history of hit and miss sets of timings in terms of implementing their tool to reduce inflation or to bring employment up. First of all, there's an intrinsic lag between the tools being implicated into the market, like a rate hike or doing something with employment. And so it is a difficult task it's kind of like shooting at a flying object. You know where it is now, but you've got to aim ahead of it. And that's what they're trying to tackle by getting it to a right point, because where it is now is not where it's going to be. So they have to calculate some risk and variables that are projections.
I'd like to ask you about your own personal experiences with inflation. I was telling
Okay.
you offline, you've seen the headlines across the country. Big box stores are cutting prices on grocery items. That's continuing, right? Walmart, Target, Amazon, for example, cutting prices on a lot of grocery items in the brick and mortar stores as well as online. Are you seeing that in Hawaii? Are you seeing deflation? Are you seeing anything going down in price? I know you're kind of isolated because it's literally an island, but no, I'm just
Uh,
curious to get your thoughts.
Not so much. We are seeing a consistent increase in real estate values and rental values. Realize our number one product that we produce is tourism. And so you've got a different demographics of a tourist that's coming here isn't faced with the burden of living in a certain day to day, week to week value. They wouldn't be able to come here if that was the case. And so in terms of the restaurants, in terms of foods costs, anything we want, we grow very little. We do have a small meat market. We grow some vegetables, but if we want it, we got to get it in here. So there's going to be that cost. And considering that oil's been fairly high, it's going to keep that up. Our biggest problem is the real estate sector, but that's analogous to what we see going on everywhere.
Okay. What kind of problem are you talking about? It's too expensive or it's
Real estate, to buy it or to
yeah.
rent it.
Okay. Why
And
why
that,
is so there's an affordability problem going on in Hawaii. You don't think that's going to be corrected anytime soon? Or maybe Hawaii is just a booming market. I'm just
Hawaii's unique in that it's an island. There's nowhere to expand. There's only so much area you can build on, and the people that come here are willing to work two, three jobs or a double household finances to do what it takes to live here. It's that important to them. Same with me. The first 9 years I came here, I took a tremendous salary cut coming from California because the wages weren't up to par with what I was doing. But to me, it was a small sacrifice. The key is milk's at $5 a gallon. I don't know what it is on the main line. Is that high or low?
I think that's pretty high.
Okay. Oil, gas, I believe it's at almost 460.
That I don't know. I mean, I live in Canada, so
I
it's
have an
a little bit
electric
different
car,
here.
so I don't know that either. But
I don't. Please comment if
I,
you're living somewhere in the mainland U.S. I don't. Gary doesn't. Let me know what gas prices are for you. But yeah,
it's
please
around
continue.
380, I believe.
Okay.
Yeah,
It really
average.
depends on the state and where you live. But yeah, Gary, we're going to move on to markets, but I'm just curious. You moved from California. If you had to move to anywhere else in the US right now for work or for personal reasons, where would you choose to work or live?
I'd stay where I am.
Okay, I know, but like let's say you
The-
had to move.
I had to. Um, it wouldn't be California anymore. There's too much smog. Maybe New York if I wanted to get back to that the crazy pace. I lived there for a couple of years. That's a great city. Or I might be at a point where I want to just have a beautiful 20-acre plot, in Oregon or somewhere. America's full with stuff, and even Canada. Look at Vancouver, just a gorgeous, gorgeous area. Um, the key is that safe streets and crime and all of those things. You look out for that. I think that the problem we're going to have with inflation is that inflation, even when it gets to their target, simply means it's not growing. And so the only answer to that is for real wages to come up to the level because it's unrealistic to assume that manufacturers who've baked in this profit are going to be altruistic and drop the price by 25%. And so if it's troublesome to afford, it has to be all about wages. And there's a push pull there.
I asked you where you would move to because I wanted to get some insights as to how an American thinks in terms of finding the right place or looking for an improvement in living standards. So basically what people are looking for these days. You tell me how you're interpreting this next chart. The consumer sentiment index, I'll put in the chart, the overall
Okay.
consumer sentiment index from the Michigan University of Michigan survey has been trending down ever since it peaked in the middle of Q1 2024. I wonder why that is. As you mentioned, look, the inflation rate has been trending down, although in the next slide I'll show on the screen for the audience here, it looks like the bottom income tertile is still concerned about higher prices, noting that to be a good reason for why personal finances are quote unquote not good, right? So,
Yeah.
the rich aren't concerned as much for obvious reasons, but people are still concerned about high prices. Why else do you think consumer sentiment has been trending down, Gary?
I think the primary thing is even for solid middle class Americans, their dollar doesn't go that far and it doesn't have the same purchasing power. So they were used to being able to afford themselves certain luxuries, certain items that are either being cut out or a workaround. And I think that that's why sentiment is going down. Sentiment is being happy, and this is a consumer nation. And so people tend to be less happy when they can't get a Gucci purse or a good computer, whatever it is that's your Achilles heel. But I think a lot of that is going to change. It's a long subject, but the whole thing with AI is going to be a disruptive force like we haven't seen over the next 10 or 20 years, because a lot of people are going to get put out of work and a lot of companies will be able to scale in ways they've never have before. And so I think that is a possible way that everything will work out.
I'm looking forward to the positives. Like you said, a lot of companies will scale in ways that they've never done before. Perhaps that could boost the overall economy and stock markets, right? I don't know.
Absolutely.
But the labor side of things we'll have to keep in that tab on. This all comes back to the Fed. I enjoy having these musings with you to talk about the economy. We're going to talk about gold. I know that's what you follow, but you have a lot of good thoughts on how the economy works. Let's talk about the Fed now. How do you think the Fed is reading all this data that we talked about? Inflation's coming down, but like I mentioned to you, the U.S. added 272,000 jobs in May. That was much better than expected. The last non-farm payrolls report back on June 7th, and employment continues to rate edge up towards 4%. How do you think the Fed is reading this data, and what do you think they're going to do later this year?
Well, one, I think they're in a quandary because the data points don't match. Typically, when you bring inflation down, the economy doesn't get more robust. And so they're trying to figure out what's going on that is making that occur. I believe the most important thing we've heard recently was the latest summary of economic projections, where they had the most recent dot plot. And so the two prior to that, there was one in March, and I think the prior to that was December. They were calling for 3 rate cuts. This one came out, I believe, the majority were looking for 2, and this is already in June. And although that's doable, because they're data dependent and saying they haven't seen the data, I think they are being over optimistic that they'll be able to cut rates by twice this year. Now, what are the repercussions of that? I think it's getting baked into the economy, but it's an odd thing that they're facing where the economy grows no matter what brakes they put on the system. They keep raising rates, the companies produce bigger profits, and it seems like nothing affects the steamrolling effect of the economy growing. And so the idea by raising rates is to slow the economy down when it has the opposite, or doesn't have the opposite effect, but when the opposite is actually occurring, well, then they'll try money supply, but they can only cut that so much. I think they're in a quandary, and I honestly believe that they are concerned that they won't act at the perfect or a good time. Let's put it that way. There's no perfect time.
The next meeting is end of July, July 31st. It's 90% chance nothing's going to happen in terms of rate cuts. That's what the CME Fed Watch tool is pricing in
Mhm.
currently. By September, though, things changed. There is a 60% chance of a cut by September. That's really just a difference of 2 months. So
It's 6-0, you said?
6-0.
It was 6-4 yesterday, though. So
Ah,
that tells you something too. Um, I believe that market participants as a whole, including professional traders, are so overly optimistic. it's like a wishful demand that they're going to cut rates sooner than later. Because that allows them to prosper more. And they have been incorrect at every juncture. And that's when we see these markets kind of fall apart and then build back up. I think we could get two rate cuts, but most likely we'll get one in November. But anything's possible.
I'd like to talk to you about the stock markets before we lead up into gold. You mentioned to me many times in the past, it's not the stock market, it's a market of stocks. And I think now is probably more
It's more
evident of
appropriate.
that
Yeah.
than any other time. If you take a look, I was doing this research last night and somebody else brought this to my attention. If you take a look at the 10 sectors of the S&P 500, 8 of them have been underperforming the S&P 500 since the middle of May. The only clear leader of the pack is tech stocks. In fact, it's pulling up the entire index.
The
Most
entire,
other
yeah.
sectors like financials, utilities have had a close correlation with the S&P 500, breaking down by June, the last couple of weeks, right? So Nvidia is now $3 trillion. It's now the biggest company in the entire index. So what's going on right now?
Well, it's a disruptive technology, and NVIDIA is the only one at this point that can do what they do. I think Elon Musk put in an order for $8 billion of the Blackwell chips, and that's, they've moved from simple AI to a thing where they're producing sims that create tokens. And it allows any company across the spectrum, a service country, a manufacturer, to just implement this technology, and it immediately streamlines their business. It's going to be more transformative than the Industrial Revolution, or it's going to be on a level that when people look back at it, they're going to go, this was the time that this shift happened, and this is why it did. The thing about it is, you're 100% correct. NVIDIA, I mean, Amazon's really strong, Apple, Facebook, they're all using NVIDIA's tools. The old aces like IBM, Intel, AMD have not been able to produce the kind of system that has this multi-parallel processing of multiple computers on a chip running in tandem with low latency. There's only one company. And if everybody in America loved bubblegum, cherry flavored bubblegum, and only one company produced it, what do you think would happen to that company? It would, not that it wouldn't be suspect to some price decline, but that would only occur if people stopped liking strawberry bubblegum. AI is huge. It is going to change every sector and have a more disruptive effect than anything we've witnessed, at least in our lifetime, but I would say in the last century, 2 centuries, maybe ever. And that's exciting. That's exciting. And so even though the S&P is moving up, the S&P isn't moving up. As you said, what, 9 out of 10 sectors aren't, they're stagnant or down. But the disruptors, which are either the guys that produce the tools to do AI or the guys that do AI, those companies are thriving. And I think that will continue.
That will continue. That is the key. Notwithstanding this continued strength of this disruptive technology, notwithstanding the fundamentally good company that NVIDIA is for the reasons you've stated, when you look at the rest of the stock markets, can you still conclude, though, that the stock market, or the market of stocks, is strong?
Certain sectors are. Across the board, you can't say that. There's weaknesses and strengths. The ones that aren't like the overall winners are somehow connected to the primary ones that are dragging it up. So
have you ever seen this level of concentration?
I don't believe so. I can't. The only thing that came close were other disruptors, like the ability to print a house. Okay, the ability to print a tool, so 3D printing. Um, uh, there have been disruptive technologies in which something costs a lot of money and now can be produced for next to nothing. And immediately, the companies that made it the old way, they had to evolve and go under. Think of Kodak and film. And the ones that were able to do something with it went right to the top. That will always be there, but we're in an age where the J curve of exponential learning and growth and development has gotten so parabolic that we are in a time of our lives that we'll all look back and go, do you remember this point? Because nothing looks the same. That's at least how I'm looking at it.
So let's talk about gold now. It's been brought to my attention that a lot of the gold rally this year was brought on by Chinese buying and demand. Now, I wonder what the charts tell us, Gary. Do you think this buying is over? Do you think it's the momentum has stalled?
Well, I, it's not a simple yes or no. Do I
Yeah.
think that the majority of the move in gold was precipitated by large central banks buying, such as India and China? They were large, huge players. They bought at record levels, but that is not the reason. I believe gold has not only moved to these record highs, but stayed there. Think of it this way, and I never heard China, they had been buying, and you get a report from the World Gold Council. Whereas last week, I think, China came out and said, we're pausing our purchases, right? Well, that makes sense. They're buying for 18 months, beginning at $1,200. It's not a record high. You say, I'm going to pause, that's going to bring it down, then they can accumulate again. I think what we are witnessing is the end of fiat currencies as we know it. In other words, I think gold has become a currency more than a hedge of inflation. And in the eyes of investors and individuals, it holds intrinsic value. And fiat currencies hold less and less. Yes, they are guaranteed by the value of the government that prints it, but they keep buying less product for the same note. And so gold tends not to. And I believe that gold is really accepted as the ultimate hard asset.
Well,
And I
I
think
have to
that's worth
just
supporting.
ask you to clarify what you mean by the end of fiat currencies. I mean, surely we're still using fiat to pay our taxes, right? Can't be
Right?
the end there. So what do you mean by that?
When I say the end, I'm talking about the fact that people understand more and more that it's just being watered down as governments print more money and accumulate debt. At what point will that not allow governments to kick the can down the road? I have no idea. This is an experiment that started in the 40s, after 40s and 50s, after World War II. I don't think currencies are in favor as much as storage of wealth. Currencies are there to purchase goods, to transact business. That will always be there, but it might be a gold note again. I just don't think people have the same faith in currencies because, as a rule of thumb, if you look over the last 10 years, they have all been devaluing. Now, when I say devaluing, I mean their buying power, not how strong they are against another currency.
Okay. People
And
tell
I,
me, yeah,
go
please.
on.
Well, I was going to say, people tell me, look, if gold reaches $5,000, a loaf of bread is going to be like $20. I'm just curious to whether or not you think gold will start outperforming not just other hard commodities, but just everyday goods. In other words, the purchasing power of gold, will that go up in real terms over time, you think?
In a non 100% correlative way, it's been doing that for the last 100 years. And we've talked about my story about a gold coin and a $20 bill in the 1900s, what
Yeah.
it bought. And if you move forward to today, that gold coin still buys the same thing, and that $20 bill doesn't. So that's always been occurring. Now, could that stop? Absolutely. If we actually got a way to reduce debt, to live within our means, and I've never thought that that could be done. I think Bill Clinton, they say, did that for a small time, but we're a spending nation. Globally, all of these nations spend, and they spend more than they take in. You can't have a budget that exceeds your GDP because all you're doing is passing it on to the next generation, the next year.
Mhm.
At some point, I would think that's going to come and bite them. However, it hasn't, and maybe it never will. We don't know how this saga is going to end. But at the end of the day, You're correct. You're going to always use currency for transactions, but you'll store your wealth and then convert that to currency, whether it's land, whether it's commodities, whether it's gold, and then do the conversion. Because we're never going to go back to the day where we traded a cow for two goats. But at the same time, corporations as well as individuals recognize the fact that the buying power has consistently gone down for over 100 years.
Well, you use the word currency to describe gold. You said gold is being recognized more as a currency. So I have to ask you to elaborate again. What do you mean by that? Do you actually mean it's a store of value because it's held as value over time versus a $20 bill? Or do you actually mean a currency, meaning a unit of transaction between peers?
Well, it's been used as both, but in the way that I'm defining it now,
Yes.
gold is more like a more valuable currency than a piece of paper currency. But you can transact with both. The difference is now you have to there's got to be a middleman. Typically, you don't buy something and give them gold. What I mean by a store of wealth is that people tend to keep their assets in real estate, in bonds, and in things that have growth potential, that gain value. And the money in the bank is kind of like the car that you drive off the lot. It loses value almost immediately and consistently. And so long run, there's always going to be a need for a currency, but it's already moving to digital currency. And
Okay.
what will that mean?
Well, let's take a look at your chart that you've got on the screen for us, Gary. Is that showing a
Okay.
head and shoulders pattern?
Sure looks like one, huh?
Yeah, well,
It
you're the
sure looks.
expert. What do you think it's going to
I
do
think,
next?
yeah. What I'm looking at is this. We're looking at gold moving from $2,045 middle of February up to the first of two record highs. This one's actually, this one back adjust, so the prices actually aren't correct. But what you saw was a low that came in on April the 30th, and the recent low that came in on Monday, June 10th, were roughly the same. That is also a 61.8% retracement of this move up. So in other words, from the move from 2045 up to the highs and then the correction, it's actually reversed. It's a 38.2, is an acceptable correction. And I think that there is too much interest in the precious metals. We've seen gold go up like this in the past, but it was followed by a huge decline. Think of middle of 2011, runs to 1900. And then between 2011, 12, 13, and 14, and 15, it traded between 1800 and 1500 for 3 years and then dropped to 1020. So it literally halved in terms of its pricing, went from 2000 to 1000. Then it took over 6 years to start moving back up. Now it has exceeded that. If you compare that to buying power of any currency on earth, they go up and down, even if you compare them to other currencies, but they don't typically regain that strength.
Okay. Well, I'm just going to be direct with my
Okay.
next question. Is it going to fall now? Is that what it looks like it's doing? Because a head and shoulders pattern implies that, that's a second shoulder, right? It's going to go down.
Here, all I can say is that it's so fundamentally driven, as it always is. A break below 2317
Okay.
will signal lower prices. If gold holds above there, and it's currently at 2343, I think it will make a stab for 2400 short term. I
20,
still,
2317 is a critical floor for you. Okay.
absolutely, it's
Yeah.
a important fib number and a double bottom. So it's a strong technical level to look at.
Okay.
Also, lastly, when we look at the stochastics and realize, huge caveat to using a momentum indicator, NVIDIA, if you look at it through stochastic, the thing's going to always be overbought for year and year and year. It's just saying that the price is high and it could pivot, but it doesn't have to. Gold just broke below the 20%, which is what we look for, and moved above. And when we compare it to what happened on May the 1st, that was this low here. This small dip corresponds to here. And this big dip corresponds to here. So I've smoothed this to 4, so it gives us real indication. I think that there is a more likely chance that gold moves higher. The numbers I would look at are, I think, because I don't have this up, if I can get my ribbon up, no, is about 2380 is the next major level of resistance, and the 21 exponential moving average, which is currently about $5 from pricing.
Okay. Good updates, Gary. I'm going to end on this more or less for the soft thought because I enjoy our musings together. Um,
Okay.
Gold is a currency, so Gresham's law, right? So bad or good money drives out the bad. Was the other way around? Anyway, bad money usually, yeah, bad money drives out the good. That's what I meant to say. What happened in Tudor England was the monarchy issued silver coins for the populace, but what they ended up hoarding those coins and using, mints that were alloys of cheaper metals. So if, let's say, one day we get an opportunity to trade in gold peer to peer, I don't think people will do it. I think people will just save those and still use fiat. In that respect, I don't think gold or even silver can ever be used as a currency again because people who, like you, may understand the value of gold. They're not going to use that in their day-to-day transactions. They'll just save it. What do you think?
I'd like to think so. I don't have as much confidence in mankind not figuring out a way to get wily. And look, they're already forging gold coins. I believe tungsten is the closest atomic weight.
Hmm.
So it's very close to what it should be. I think that if there is a will, there will be people that try to take advantage of it, but it's a lot harder to do than to print more money and take the buying power away of a
Sure.
$5 bill. So I agree with you 100%.
All right. Where can we follow your work, Gary?
Thank you. Thegoldforecast.com, that's our premium site, our YouTube channel, The Gold Forecast, and on Twitter, it's Gary S. Wagner, at Gary S. Wagner, and I'm still doing daily commentary for Kitco Media.
Great. We'll put the links down below, so make sure to follow Gary there. Thank you very much.
Thanks for having me, David.
Yeah, great talk. We'll see you next time, and thank you for watching. Don't forget to like and subscribe.